Joining me right now is Macromavens President Stephanie Pomboy. Stephanie, it's great to see you. Thank you so much for being here. Merry Christmas to you. I want to kick it off with getting your take on the year that we are ending and what you're expecting for the new year for markets.
Well, thank you for having me, Maria, and Merry Christmas to you as well. I wish that I had a more jolly Christmas message to impart, but I think after a fairly rocky 2022, we're going to experience much of the same in 2023. The way I see it is pretty much 2022 was a re-rating affair. It was the markets adjusting to a new higher level of interest rates on, the Fed's tightening. 2023 will be when we see the fallout from those rate hikes in the economy. I mean, obviously, on the front lines, housing has already slowed sharply in terms of volume. I think price will follow that in 2023. But you'll also see a broadening out of the hit to the economy to just general consumers struggling to service higher price debt. And my main focus of concern is the corporate sector, which has a tremendous amount of debt that rolls next year in 2023. And they're going to be rolling that paper at, interest rates that are in some cases double or triple what they were borrowing at prior. And we've got a lot of companies that are very marginal that are not going to make it. So I think you're going to have a default cycle in 2023, and that will reverberate through all the markets, both the corporate credit market and equities as well.
Yeah, this is a big deal, and you've been talking about this for so long with me on Mornings with Maria. I want to get your take on how severe it's going to be and what this is going to mean for the backdrop, because so far the macro story has basically been offset. The weakness has been offset by a tight labor market. You're talking about a profits recession, about earnings estimates that need to come down, and these so-called zombie companies that have so much debt, they're not going to be able to pay the interest payments. You think they'll go bankrupt?
I believe they will. If you couldn't service your debt before with your income from existing operations, how are you going to do that when rates are double or triple what you were paying prior? I think this is going to be a real problem. And obviously, you're seeing around the periphery a lot of trouble already. We've seen, increased defaults. Obviously, you've had bankruptcies like Revlon and AIG, which I think is kind of an interesting echo through history that, here we are all the way out 14 years later from 2008, and AIG is now, filed for bankruptcy. So we'll see a lot more of that. You've seen a massive shift in credit ratings already, which precedes the downgrades. So we've gone from upgrades outnumbering downgrades 3-to-1 to now downgrades outnumbering upgrades by 2-to-1. But so I think you've got $1 trillion in debt on the balance sheets of these zombie corporations that will likely just go up in a puff of smoke, sort of like FTX did.
Wow.
And then the tightening in the broader credit market that arises as a consequence of that will start to hit other corporations. I mean, I think what we're going to shatter in 2023 is the myth of strong corporate balance sheets. People talk about the corporate sector, they paint it with one brush, and very much like the consumer sector, it's very bifurcated. You have a handful of companies that have a very strong balance sheets, Apple, et cetera, and then you've got really everyone else that's in much dire straits. So cash positions, this is just a little glimpse into that. The total cash position for the S&P 500 companies, the top 10 companies hold more cash than the bottom 400. And those are the largest 500 companies in the country. So imagine what the cash position is when you broaden the lens out to the top 1,000 companies. So we've got much less balance sheet strength to work with here. And again, we have all this debt that rolls. Next year, $1 trillion of debt rolls, and then another $1 trillion the year after that, and another $1 trillion in 2025. So there's going to be no respite from this onslaught of higher debt service. And as you mentioned, I've been a broken record on earnings. We got the personal income and spending numbers, and you see that trend where income actually surprised on the upside, but the spending numbers surprised on the low side. And people are trying desperately to shore up some savings and try to repair their balance sheets a little bit, which will only further depress corporate profits going into 2023.
Stephanie, real quick before you go, how do you want to be invested going into the new year with all of this worry?
Yeah, well, I guess I would be very defensive. I think in the backdrop I'm describing, you'll continue to see a rally in the Treasury complex as the 10-year yields start to come down, pricing in what I believe will be a much more material recession. That could help utility companies. That's an area I would be interested in. I'd generally be defensive. I'd be holding as much cash as you're able to hold. I'd probably be positioned in hard assets. The precious metals area I like a lot. And to the extent that you're a long-only manager and you've got to put money to work somewhere, I'd probably be overweight emerging markets versus the developed world economies, where these higher interest rates are going to have a major impact because we're also massively levered. And for the most part, the emerging markets have much less debt on their balance sheets than we do. So there's not a lot of great opportunities. I'd be very defensive again in the stock market, and definitely underweight the consumer discretionary space. And I wouldn't touch corporate credit with a 10-foot pole. So
all right,
I know what to avoid.
Yeah. We will leave it there. It's great to see you this weekend, Stephanie. Thanks very much for being here.